Welcome to the Deep Dive. Today we're doing a high-speed extraction, really digging into what happened on October 11th, 2025. A massive, just violent correction hit digital assets.
Yeah, it was quite something.
We've got the source stack, tells a pretty dramatic story. So let's distill the shock and maybe find the strategic opportunity hidden in there.
Okay. Well, the main takeaway right off the bat is this. It
Yeah.
was a classic liquidity shock, pure and simple.
Liquidity shock. Oh,
Yeah, driven almost entirely by external geopolitical forces. This wasn't some fundamental crypto failure.
not the tech itself breaking down.
Exactly, the big catalyst. The U.S.-China trade war escalating dramatically. President Trump announced a mandate for an additional 100% tariff on Chinese imports, effective November 1st.
Wow, another 100%. That's a huge global risk signal. And
Yeah.
we saw traditional markets react immediately, right? A big risk-off move.
Yep. S&P 500 dropped, 2.7%. NASDAQ plunged 3.6%. Standard reaction to that kind of news.
But then you look at crypto. Bitcoin. It fell from its recent high, near $125,700, all the way down to $104,782.
Yeah.
That disparity is, well, staggering. How does that geopolitical fear translate into such extreme selling in crypto specifically?
Well, that difference just screens leverage, high leverage.
Oh, okay.
When that tariff news hit, it signaled major systemic risk. Big players, institutions, they were forced to liquidate their riskiest, most liquid assets first to meet margin calls elsewhere.
And crypto is often top of that list for liquidity and risk.
Precisely. So they sell crypto fast to cover positions in, say, equities or bonds. It becomes a cross-border capital scramble, really, a reset.
You can see the stress almost instantly. I mean, watching that high-yield stablecoin, USD,
Oh, yeah, the USD situation.
it uses those leveraged yield strategies, right? And it briefly depegged, traded as low as 60 cents on Binance. That must have been sheer panic for anyone holding it.
Absolutely. It was like the canary in the coal mine. It just proved this wasn't normal fear selling. This was a massive forced unwinding of leverage, cascading liquidations.
Right. And it also kind of poked a hole at a big narrative, didn't it?
You mean the digital gold idea?
Yeah, that one. Bitcoin is a safe haven.
Well, during this acute shock, this deleveraging, it failed that test. Crypto assets correlated almost perfectly with risk assets like the NASDAQ. They moved together.
So not a safe haven in that specific scenario.
It seems that safe haven dynamic works better maybe during sustained monetary inflation, like currency devaluation, not these sudden, sharp, systemic shocks driven by geopolitics. Different beast entirely.
Okay, so we saw the panic, the leverage purge. Let's pivot a bit. Despite all that chaos, the long-term thesis seems intact for many. What structural signs give institutions that kind of confidence to stay in the game?
That's the interesting part. There's definitely serious confidence still there, structurally speaking. Two key supports, really.
Okay, what are they?
First, regulatory clarity is much better. Remember, the SEC approved those generic listing standards for crypto ETPs back in September.
Right, the exchange-traded products, like ETFs but for crypto.
Exactly. That provides a kind of institutional certainty. It removes a huge barrier for big money managers who need clear rules.
And that regulatory maturity then tees up another potential catalyst, right? A more tactical one.
Correct. We're heading right into a really interesting period. There's this cluster of, I think, 8 spot XRP ETF decisions expected between October 18th and the 25th.
XRP ETFs. Given its history with the SEC, approvals there would be significant.
Hugely significant. And it could open up another major institutional gateway specifically for XRP. High risk, high reward, definitely one to watch.
Okay, so beyond the ETF speculation, there's a more defensive structural trend too. Real-world asset tokenization, or RWA. Analysts are throwing around huge numbers, like $5.25 trillion by 2029. Why is that getting so much attention?
RWA is fascinating because it offers something different, genuine, potentially defensive yield. And crucially, it sort of decouples digital assets from pure crypto volatility. Well, you're tokenizing stable off-chain assets. Think U.S. treasuries, real estate, private credit. Their value is backed by something tangible, something outside the crypto ecosystem itself.
So institutions get the efficiency of the blockchain, the tokenization, without taking on pure speculative crypto risk.
Exactly. That's incredibly attractive for players who want stable, predictable returns using this new tech. It's a major structural growth theme.
All right, let's bring it back to the individual learner, the investor, maybe watching this dip. How should they approach this strategically? What's the takeaway?
Look, given this tariff war situation, we're likely looking at prolonged, unpredictable geopolitical volatility. Things could stay choppy for a while.
So jumping in with a lump sum might be risky.
Very risky. The clear imperative here is dollar cost averaging. DCA, scale in gradually. Don't try to time the absolute bottom because honestly, it's impossible to know where that is right now. DCA minimizes that timing risk.
But you mentioned specific levels, like maybe reserving some capital for a potential Bitcoin retest around $106,000 or Ethereum near $3,500. Why those levels specifically, instead of just buying now?
Good question. Those levels, around 106K for Bitcoin and $3.05 for Ethereum, they represent important psychological areas and zones where a lot of liquidity likely cleared out during the crash.
So potential support level.
Potential support, yeah. Historically, after severe deleveraging events like this, the market often rewards patience around those kinds of thresholds. So reserving some capital for opportunistic buys if we revisit those zones makes sense, but DCA is the main strategy.
Okay, so wrapping up. The immediate future, say through Q4 2025, looks defined by uncertainty, driven by this U.S.-China conflict and the leverage reset we just saw.
Absolutely. And that conflict pretty much guarantees sustained inflationary pressure going forward.
How so?
Well, trade analysts like GTRI, they're already projecting higher costs. Everything from EVs to semiconductor parts is likely going to get more expensive because of these new tariffs.
Right, that makes sense. So here's a final thought. If Bitcoin, kind of failed as that safe haven during the acute crash, does this sustained geopolitically driven inflation mean its real test as digital gold, as that hedge against steady fiat devaluation, is actually only just beginning?
An interesting question to ponder. That's definitely something for our listeners to think about.